The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Northwest Quadrant Wealth Management, a registered investment advisor and separate entity from LPL Financial. Welcome back to Financial Focus Radio Show on our Northwest Network. Northwest Quadrant Wealth Management has offices in Bend, Eugene, and John Day, serving clients from all over the Northwest. Give us a call today for your free retirement review. Now, back to the show.
Call our office to get that scheduled. Our number at the office is 800-743-0988, and we'll give you an hour of our time to talk about anything in your financial life, and we won't bug you afterwards. Thanks for joining us. My name's Tyler Simones. That is Josh Fenili. We are partners at Northwest Quadrant Wealth Management here in the great Pacific Northwest. We appreciate you spending some time with us. According to the Department of Labor, the number of employees at the federal government has increased by 18,000 from the end of February of this year until the end of June of this year, while the number of employees at local governments has declined by 1.2 million over the same 4-month period. I am wondering when we are going to have a fiscal conservative anywhere in Washington ever again. I guess the last one was Ronald Reagan, maybe. I mean, when was the last time we had a fiscal conservative?
Well, Bill Clinton had a positive.
You mean he had a budget surplus?
Yeah, he had a budget surplus.
Yeah, but we don't want to consider him a fiscal conservative, do we?
I don't know. I mean,
he was
cart before the horse.
Yeah. Well, here's my issue with that is that, I just at some point, and I'm not blaming one party or the other. At some point when times are good in this country, we have to make some decisions to cut some spending and to pay down debt because we're going to always have bad times. And what we're not doing in this country is taking advantage of the good times. So the period Josh is referring to is the late 90s when the economy was growing at 6% and unemployment was 4%. And, the tax receipts were obviously really good. But we just had the longest expansion in U.S. history, albeit it wasn't the most robust one. But we had 11 years of expansion in this country, and we did nothing about trying to pay down debt. In fact, we cut taxes and so made the tax or the deficit worse. I mean, we just, in the month of June, increased the deficit by essentially $1 trillion in 1 month. It took this country 192 years to get to $1 trillion, and now we're doing it on a monthly basis.
Every 29 days, basically.
So I just would urge you, it doesn't matter until it does. And so, we have examples in business. Bear Stearns was around for a long, long, long time. Lehman Brothers was around for a long, long, long time. They had 40-to-1 leverage, meaning for every dollar they had in cash, they had $40 of borrowed money on their balance sheet. And it worked fine while things were good, but as soon as their counterparties decided that they were not a good trading risk, 3 days they went out of business. And so the United States of America has counterparties. We have different countries around the world and investors around the world that buy our debt and allow us this funding to continue. For now, because we're the reserve currency of the world, it's fine. But that's not going to be true forever. And this Chinese government is working really hard to try to come up with a solution and have a reserve currency.
I mean, it's definitely not Washington specifically. It's central banks in unison around the world are doing this. And the argument always goes, as long as we're relatively the best house in a bad neighborhood, we're going to be fine. But de-dollarization is on top of mind of all of our geopolitical enemies. And they're working as hard as they can to accomplish that feat.
Yeah, because they didn't spend trillions of dollars also fighting wars around the world for the last 20 years that we did also. So, sometime when you're voting, you have to remember that these things, if you care about what you probably care about, the American way, these things have to be on your mind when you're voting. One of the other things that's happening in the market that's quite amazing, because we're talking about the NASDAQ being expensive like it was in the late 90s, the volume on the NASDAQ essentially this year has been 4 times the trading volume of the New York Stock Exchange. The last time we saw that was in the late 90s. So the amount of trading that is happening on the NASDAQ versus the New York Stock Exchange is 4 times the amount. And we know the stocks that are getting traded. It's just quite crazy.
Well, and the concentration risk in the triple Qs now, 6 stocks represent 50% of the index. It's the most concentrated it's ever been. And, many of those names are trading at, well, it seems like a conservative multiple, 30
times.
30 times.
Earnings, yeah. All right, let's kick off with Financial Focus University. So in this segment, we thought we'd talk about liquid alternatives. People talk about them on the TV as called liquid alts. So let's first talk about what liquid alts are. So, hedge funds have been around for quite some time, and they are considered a version of alternative assets. But there was barriers to entry to hedge funds. They had lockup periods. You had to be an accredited investor, meaning you had to have a certain amount of money or some level of sophistication to get into these hedge funds. They had big, high minimums. And so the asset management business, so the mutual fund companies, said, you know what, that is a really profitable part of the asset management business. We want to stake our claim and get some of those assets that are going in there. And so what they did is they created 1940 Act mutual funds, which a 1940 Act is in part of Congress. They established a law to be able to create a mutual fund. And so a 1940 Act mutual fund has to be liquid daily, and that's why we call them liquid alternative assets, liquid alts. And so the asset management business mutual fund company said, why don't we use some of these hedging strategies and all these different hedge fund strategies, alternative strategies, and put them in a mutual fund and create daily liquidity so we can offer them in 401k plans and to the masses. Because we can charge much higher fees because they're alternative. And so the idea and the pitch is by the asset managers to the brokers out there, your brokers, all of you out there are listening, your financial advisor and your broker, the pitch they're getting is, well, you need to have a part of your client's portfolio that is not correlated to the market, meaning that the beta is opposite of the market, and that you need low correlated assets that have low volatility return characteristics. And so there's funds out there like long short, non-traditional bond, market neutral, managed futures, global macro funds, all these different strategies that these asset managers and hedge fund managers have employed to try to be a non-correlated asset to the rest of the market. And I would say that they do a decent job of doing that. It's very expensive and very tax inefficient way to do it. But just when you need these funds to be non-correlated and hold the part of your portfolio up is generally when they blow up, and they blow up worse than the market. Now, it's not true across the board, but non-traditional assets. So, and it's done in the high net worth space at family offices and Goldman Sachs and all these JP Morgan, all these people, they buy these things because they think they're getting this thing that the rest of us don't have access to. But the funny thing is the joke is on them because they're paying really extraordinarily high fees to dramatically underperform just buying the S&P 500 index with actually more long-term volatility. So if you look at how the alternative asset management business has done over the last 20 years, they've done an abysmal job at delivering on what they say they're going to do. Now, there are some out there that have done what they say they're going to, but it's very small. It's less than 5%. So the vast majority of these alternative asset managers have charged you extraordinarily high fees, dramatically underperformed, and done it in a very tax inefficient way. When Paul Tudor Jones started the first hedge fund, way back when, collectively, the only people that have made money in hedge funds are hedge fund managers. They have not taken a penny out of the market as an industry and given it to their shareholders at all. They've just taken it and put it in their own pockets. And so our concern for you, all of you out there listening, is when we have volatility and volatile markets and markets like we've seen, this is when financial advisors come out in droves and try to put these things in your portfolio and resist it with just tell them that they're fired and that the suggestion of it is laughable because the performance net of fees and after taxes is a unmitigated joke.
Yeah, they're most certainly going to be pushed by the industry again. I mean, the last real wave of these we had was in 2015 after a flat market, and it's coming down the pike sooner than later.
All right, if you want to be part of the show, give us a call, 877-670-7117, or go to our website, financialfocusradio.com. When we come back, we're going to talk about index concentration and what you should be doing about it.